we have a special conversation lined up for you. We have Prashant Khemka, founder WhiteOak Capital, joining us on this Independence Day special conversation. Welcome, sir. Harsh here. Always great chatting with you. So let me start off by giving or asking you for guidance. What's the best space to be in this 79th year of independence? If I were to ask you for that, one big sector or space or pocket in all of this uncertainty that we are seeing globally that could outperform this year and could maybe help some of our viewers gain financial independence, maybe not in this year, but maybe a couple of years from now.
Thank you, Harsh, for having me here on the show today.
So pleasure is totally ours.
So, see, I would answer the question a little differently, not trying to avoid the question.
Sure.
But actually, some of these questions are of the nature that the answer is impossible for anyone to know. Not just myself, I'm saying impossible for anyone to know. So it's impossible to know which sector is going to do better next year, according to us. But what I can say is, for financial freedom that you talked about, longer term financial freedom, the few steps that one needs to follow, first of all, depends on whether an individual has a corpus to invest or not, whether they have the savings that they can invest in equity market. If they don't, then start saving. That's the first step. Obviously, a lot of people end up spending nowadays. I see younger folks end up spending almost everything that they earn and take some borrowing. Then there is no room for investment or financial freedom. You have to decide what is a priority. Your priority to have a $200 mocha or $100 mocha ahead of building a path towards financial freedom, then that is your choice and you have to decide. Otherwise, you can start with a target to save on a monthly basis. What is the minimum that you would save? And just I'll give you a hint, the higher, the better. And then from this savings, you determine an asset allocation program. Maybe you can, take help from a financial advisor on this front, depending on your risk appetite, your time frame, your expenses that you see ahead of you. You can come up with what is the right asset allocation. Risk appetite plays a very important role, and also the comfort with equity markets. For me, only feel comfortable if 100% is invested in equities. If anything less than 100%, it's very discomforting to me, and hence have always been 100% in equities and fully invested at all times. So that comes me to the third point. Once you've determined your asset allocation, don't flog it around. It should be truly a structural asset allocation. It should not change month to month, quarter to quarter, depending on macro headlines like Trump is imposing tariffs, Trump is reducing tariff. All these things, they should not lead to, I would say, there should be hardly any events or instances where you have a step function change in your asset allocation, other than an evolutionary manner where, depending on your age and risk appetite and responsibilities as they change over time, that may have an impact on your asset allocation. So to recap, if you don't have a corpus, start saving. If you already have a corpus, or once you have a corpus, determine an appropriate asset allocation program and then stick to it. Don't get whipped around by the market volatility and media headlines. Harsh, back to you.
So you've given us a fantastic 30,000 feet view. If I were to just probably ask you a follow-up. So a lot of investment analysts and big investors say that you should sit on cash at certain points in time, and that really helps you deploying cash at the right time, especially where equity markets is concerned. You are more of the view that be fully invested at all points of time. Give us your take on why is it that you feel so? Do you just see that that's the quantum of opportunity always available in equity markets? There's always inefficiency somewhere. Is that where you come from when you give us that?
So Harsh, few things. First of all, I've heard many market gurus talk about the beauty of keeping in cash, staying in cash, and whatnot. I'm yet to see one that has really benefited over a long period of time by doing so. And for every one example that you might be able to cite, and I won't go into verification of that, there would be dozens, if not hundreds, who have lost money doing that. Okay, I don't believe that it is doable, and hence I have never even tried. So long ago, I saw a movie about the time when I started investing in equity markets in the mid 80s. I saw the movie Dawn, where there's a dialogue, Dawn ko pakadna mushkil hi nahi, namumkin hai, which applies, though Dawn gets caught in the movie market, you can't catch the bottoms and the peaks and whatnot. So I've never tried to catch bottoms or find bottoms in the market at a market wide level. You can do it for individual stock basis. So now that is one perspective to look at it. Now there's another perspective I'll give of why I believe fully invested makes sense. It's a bit mathematical. I have at least reached the conclusion that of all the asset classes, equity gives the best returns over time. Yes, it is a little bit more volatile in the short periods, but in the time horizon, which is over decades, over a lifetime, that volatility is nothing. So longer term, equity provides the best return. That is number one. Second is that timing or calling the market direction in the near term is impossible. So first, hypothesis that I believe in longer term, it's the best. So it is obviously going up at a faster pace than any other asset class. Second hypothesis, it is impossible in the shorter term, it is impossible to predict where it's going. Yeah. When you combine the two, it's almost like mathematical, A equal to B, B equal to C, so A equal to C. So when you combine the two that I talked about, then to me it makes tremendous sense to stay fully invested at all times. That's the only logical conclusion if you agree with the first two, that A, stock market is the best return over time, and B, it is impossible to time. If you combine the two, the only conclusion is to stay fully invested at all times, Harsh.
Makes absolute sense, Mr. Khemka. Hi, Mahima, also joining this side. Just want to understand in terms of where earnings stand, right? We're almost at the fag end of where Q1 FY26 numbers have almost come out for most of the companies. Just wanted to get your sense from the first reading of it as to how earnings will pan out for FY26 going forward. And a follow-up with regards to that, do you think now valuations perspective, do you think it's attractive enough, markets are attractive enough, and if one wants to go ahead and invest today, do you think this will be the reasonable valuations to enter at?
Mahima, I think it's very reasonable valuation to enter at. It is in line with the last 11 years, let's say. Since 2014, the multiple has hovered around 20, 21 times. Right now, we are right there. I'm not saying that's the right multiple or wrong multiple, but one of the measures or parameters that people call a market expensive or cheap is by looking at how is it trading relative to history. So right now it is trading right in line with the last 11 year since 2014 average multiple the market. So that is one. Second, to your point of earnings, I think the first quarter, everything that we've seen so far, obviously there are always puts and takes. Certain sectors have done better, certain sectors not done so well. Within sectors, there are certain names that have done even better or not done so well. So that's always the case. But in aggregate, the numbers of the quarter are consistent with what we believe would be a year of low double-digit corporate earnings growth. And
Okay.
that's in line with longer term normal. I think we had after COVID 4 years of super normal or above trend line, I would say above trend line earnings growth. Last year it was a bit softer. And this year we're expecting in line with the trend line, which is a low double digit earnings growth from the market.
Understood. Mr. Khemka, in terms of where the flows are concerned, DIs have been resilient enough to keep the markets in check. But year to date, we've seen that FIs, has been net outflow only. It's around 1,92,000 crores. Just want to understand as to, what will be the next trigger that will bring back FIs in India when it comes to, the overall net inflow position that will be in positive.
See, the market is the biggest trigger. The market is going higher. There's some puts and takes. So, see, first of all, we have to understand that out of $800 billion or so invested in India by foreigners through the FPI route, 600 or so is as part of multi-regional funds, be it Asia Fund, EM Fund, or Global Equity Fund. Only approximately 200 billion is India dedicated funds, people choosing to invest in India. Whereas the vast majority, 75% or so, is people choosing to invest in emerging markets, and a small allocation flows through to India. So if there is a situation where people are negative, investors globally are negative, say on emerging markets, even if they're positive on India, even if the 200 billion has grown by, let's say, 5% to 210 billion due to net inflow of $10 billion. But what if this $600 billion sees a 10% outflow or even a 5% outflow? So then that is minus 30. So that minus 30 would be far bigger. And that's because not people are just cutting down on India exposure within EM, but just overall global investors are cutting down EM exposure. There's been 5% outflow from EM funds, let's say, that would lead to 5% outflow from that $600 billion bucket, vast majority of which is EM. Yeah, and 200 billion would only get 5%, which is 10 billion. So even though investors are allocating to India and are positive, the overall flow can be negative. That's an important point, my view, to understand. And what we've seen over the last year, 2 years, is exactly the same phenomenon where EM has seen considerable outflows and that has dominated the flows in India. I'm not saying all throughout India flows have been positive. Of late, India dedicated flows have also turned somewhat weak and negative, and that is to do with Indian market underperforming this year by about 20% relative to the rest of the EM. Markets everywhere, investors everywhere are extremely predictable in that they put money in what has recently done well and they take money out of what has recently done poorly.
Sure. Sir, you've been an investor for a very long period of time. So you've seen various cycles, various themes play out over 3, 4, 5 years. One or two or three of those likely themes may be energy transition, maybe data centers, maybe AI and technology. How do you suggest, or how are you playing some of these themes? Or do you believe that some of them are premature and maybe others will do well? So give us your take.
No, Harsh, you're right. You look, there are two things. One is the themes playing out in real world, and B, is there a way to benefit from them in the stock markets, from the equity markets? Yeah. So some of the themes that you mentioned are very true. I'll throw in AI as well into that, along with energy transition, and so on and so forth. Now the question is, in the listed market space, what are the opportunities either directly or indirectly benefiting from them? And B, how are they valued? Whether investing at current prices, even if the theme does extremely well as expected or better than expected, whether investing at current prices, would they deliver good returns? Obviously, we would like outsized returns, but even whether they would be able to deliver better or superior returns. So those analyses have to do. As an example, let's say during 2003 to 2007, infrastructure, real estate, and major boom in the real economy was there. And those were the strongest themes at that time. But most of those sectors didn't end up making money. In fact, if you invested beyond a certain point in time, let's say 2005-6 time frame, those who might have invested in 2003-4, got in very early, could have made money since that time even till today. But those who invested in 2006-7 time frame, when the themes were at their strongest in the real economy, in the real world, in fact, might still not have recovered their money, at least not recovered inflation adjusted or market adjusted. Yeah. So those are important considerations. So I agree with you in terms of the themes that we'll see in the real economy play out very well globally as well as in India, this whole energy transition and the AI phenomenon. The challenge is to identify names that directly, indirectly benefit and whether they are at appropriate valuation at this time.
Right. Thank you so much, sir, for coming in, speaking with us on this very special day. Wishing you and yours a very, very happy Independence Day, sir. And thanks for coming in and giving us that
perspective. Thank you,
perspective.
Harsh. I'm sorry not dressed for the occasion, but thank you for having me.
Not at all, sir.
Much appreciate you.
Not at all. I'm sure that all of your views, sir, were resonated very well with the viewers.
Wish you and all your viewers a happy Independence Day.
Thank you, sir.